Welcome to The Explainer. Today, we're unpacking an absolute tech behemoth, and we're channeling that true modern investor essence to just cut right through the noise. Listen, our goal here is simple. We're going to turn your AI confusion into AI confidence. We are looking at Meta. Now, they power over 3.3 billion daily users across their apps, but make no mistake, we're not just looking at a social media company here. We're talking about one of the world's absolute largest advertising and commerce engines. So get comfortable, stay focused, and let's map out exactly how this massive ecosystem actually operates.
All right, here's our roadmap for today. First, the Meta ad engine. Second, AI infrastructure and algorithms. Third, the tech transition phase. Fourth, we'll dive into financial ratios and margins. And finally, number 5, what is in it for investors?
Okay, moving right into part 1, the Meta ad engine, volume and pricing power. To really get Meta, you've got to look at its family of apps, because that is what drove a pretty staggering 98.7% of their total revenue in 2024. And a lot of that incredible volume is backed by serious pricing power, which is entirely driven by algorithms. A perfect example is GEM, a proprietary algorithm used specifically for precision ad targeting. Right? So because AI tools like GEM are massively improving advertiser demand and targeting, Meta literally pushed the average price per ad up by 10% in the third quarter of 2025. The big takeaway here, they aren't just spamming more ads at you. They're showing way smarter ads, and they're charging a hefty premium to do it.
On to Section 2, AI infrastructure and algorithms. This is the engine powering tools like Advantage+. You see, Meta's true competitive moat is vertical integration. We're talking custom data centers powering the Advantage+ suite, which is already handling over $60 billion in ad spend.
But wait, it doesn't stop at display ads. They're aggressively expanding how they make money. We're now seeing them embed Meta AI across WhatsApp, Messenger, and Instagram. This is an absolute game changer. Click-to-message ads are creating direct sales funnels, so transactions happen right inside your chat window. And they're pushing these business AI tools hard in global markets like Mexico and the Philippines, letting merchants just seamlessly automate lead gen and sales chats.
Now, the real magic is in how they organize all this massive data. Historically, Meta trained separate, kind of clunky models for each app. Now, they use the Lattice framework to recommend apps in one surface for user convenience. Actually, let's just say for user convenience. Think of it like this. If you interact with a funny video on Instagram Reels, that behavioral data seamlessly, immediately informs what shows up on your Facebook feed. It breaks down the walls. It just makes everything hyper-relevant across the whole shebang.
So, that brings us to Section 3, the tech transition phase. This is where things get tense. Meta is aggressively pivoting, shifting billions away from consumer features and dumping it straight into an unprecedented AI infrastructure build-out. They are basically playing a two-handed game in the AI arms race. You'll see them leveraging the Llama LLM model as open-source LLM, Avocado LLM to commercialize LLM. Actually, scratch that. Let me frame that dual strategy a bit clearer for you. They're pushing open source with Llama while simultaneously developing the Avocado LLM to commercialize directly against heavyweights like Google's Gemini. Avocado is slated for early 2026, dropping as a closed frontier model built specifically for making money.
And to fuel this massive dual strategy, the spending is, well, it's historic. Meta's guided for over $70 billion in capital expenditures for 2025. That's a 70% jump from what they spent in 2024. Management is looking Wall Street right in the eye and saying, compute demands have absolutely surged, and the time is right to start building the power, land, and GPU capacity they need for superintelligent foundation models.
But hey, let's take a quick stop and think moment here. While the AI ad engine is humming, we've got to talk about Reality Labs. That's the division for their VR and metaverse dreams. They recently pulled in $2.1 billion in revenue, which sounds great, right? Until you see the eye-watering $17.7 billion in operating losses. Ouch. This is a clear, heavy drag on group profitability that investors simply cannot ignore.
All right, Section 4, financial ratios and margins. Let's ground this whole narrative in the hard numbers and see what the return on invested capital actually looks like. Looking at the top line, Meta pulled off a 26% year-over-year revenue growth in Q3 2025, hitting over $51.2 billion. That's massive. It proves that despite everything else going on, the fundamental ad engine is just firing on absolutely all cylinders.
And even with that crazy $70 billion CapEx bill we just talked about, Meta is still an absolute cash cow.
They posted a highly impressive 40% operating margin in Q3. Their underlying P&L is incredibly resilient, spinning off enough cash to self-fund these massive sci-fi ambitions.
But if we flip over to the expense side, you can definitely see the pressure points. Total costs shot up 32% year over year. Why? Well, it's driven straight by that infrastructure spend, the skyrocketing payroll needed to poach top AI engineers, and a few legal charges. So we gotta be real. If cost inflation starts outpacing revenue growth, we might see some near-term margin compression.
Also, a quick heads up on an accounting anomaly from this period. Meta took a massive $15.93 billion one-time non-cash income tax charge. This was tied directly to the One Big Beautiful Bill Act, which forced them to write down deferred tax assets. Now, it totally distorted their reported net income for the quarter, but remember, this is just a paper adjustment. It's not a flaw in their actual business operations.
Finally, Section 5, what is in it for investors? Let's bring this all home and see how the market is actually pricing this tech giant today.
Because there is a really fascinating valuation disconnect happening right now. Meta is sitting on a fortress of a balance sheet with over $44 billion in cash. Yet Morningstar gives it a fair value estimate of $850, while it recently traded around $668. So at roughly 21 times forward earnings, Meta is actually trading at a discount compared to the rest of the Magnificent Seven. Basically, Wall Street is terrified of that huge AI capex bill, and it's keeping the valuation down, even though the core business is absolutely crushing it.
Which leaves us with the ultimate question. Management is pointing to 2026 as the year the AI yield cycle really kicks into high gear, where all that insane compute power unlocks even deeper ad conversions. The setup is clearly there. So do you have the patience and courage the right entry to weather these short-term spending fears before Meta's ultimate AI monetization takes full effect? Something to chew on. Thank you so much for joining me for this explainer. Keep analyzing, keep learning, and I'll catch you next time.